Welcome to Global Tax Talks. My name is Edna Gitachu. I'm the Africa Tax Policy Coordinator. We are filming this in Mombasa, Kenya, at the sidelines of the Africa Tax Policy and Business Symposium. I'm delighted to be joined by my colleague, Job Kabochi, who is a tax and legal services leader here at PwC Kenya. Job, welcome to the Global Tax Talks.
Thank you, Edna.
So Job, there have been some changes around the significant economic presence tax. In June of this year, we saw that the threshold for significant economic presence tax was removed. What are the implications of this for business?
Thank you, Edna. I think one needs to go further back prior to the removal of the threshold you talk about. I think the significant economic presence tax is a clear indication of the journey that Kenya has walked the last couple of years. I would say maybe 5 years or so. You remember, prior to us having the significant presence tax, we had the DST, or the Digital Services Tax, which was a clear indication of the government that was looking to tax the digital economy. So what has happened is that the base has tended to expand, because when we first introduced the digital services tax, it was only applicable to the digital marketplace players, non-resident digital marketplace players. Yeah, but with the introduction of the significant economic presence tax, we widened the base. We're talking about non-residents who then have services being provided through any electronic means, and not only those that are captured through the digital marketplace. So that expansion then started off in December of last year, when we had this Tax Law Amendment Act that then sought to replace traditional DST with this significant economic presence tax, which, like I'm saying, has a wider base. But then what interestingly happened is that we still retained a threshold that existed with the DST, which was about this tax is only applied to service providers that had supplies of a value of up to 5 million Kenya shillings. That's just shy of what is it?
$38,000.
$38,000, yeah. Call it $40,000. Now we've removed that threshold. So we're now sitting in a situation where this is a government that is looking to tax any non-resident who's providing these services that are then being provided through the digital or through the electronic means without having a threshold. That means even one transaction with a Kenyan user or buyer of your service gets you into the net. And you're then required to register and account for that tax to the government. So what does that mean? It means a lot of compliance burden for even very small businesses. And in my view, that's going to cause a lot of businesses to consider whether they need to really be trading with or making their services available to Kenyans. Over and above that, I believe there could be certain businesses that are then altogether going to stop providing services to Kenyan consumers. So clear desire to tax, but unfortunately this might not necessarily result in the revenue mobilization or revenue collections that the government is looking to tax.
Thank you, Job. Let's switch gears and talk about electronic invoicing. And Kenya has been expanding its scope of electronic invoicing. What are the opportunities and challenges for business with the electronic invoicing system?
The introduction of e-invoicing in Kenya is not unique. I would say it's following on the trends that we are seeing in other parts of the world. And this is both the Revenue Authority embracing technology, as well as taxpayer also embracing technology. And I see it as a double-edged sword, in the sense that it works both for the Revenue Authority as well as for the taxpayer. If I look at the taxpayer, embracing the use of e-invoicing ensures that you're able to capture your invoices or transactions and quickly transmit that information to the Revenue Authority in almost either real time or near real time in the Kenyan context. Yeah? And at the end of the day, the Revenue Authority is even able to play back that information to you through your monthly VAT returns. We are now talking about auto-populated VAT returns. And over and above even giving you the VAT return, there is what they're calling, if you think about, say, like VAT, they're talking about VAT dashboards. So the Revenue Authority is able to start giving you or playing back information that perhaps you did not even have around your sales, around the expenses that you then get to incur. So to me, I think there is a benefit in how business is then going to be able to use e-invoicing. But at the same time, from a government perspective, I think there is an angle to it whereby the government is actually getting a lot of data through these e-invoicing transactions. And I think it's then going to make certain conversations easier. You know, we've been involved in, having conversations around policy direction that the government is taking. And sometimes we do not have the backing information to have those intelligent conversations. So for the Revenue Authority, I believe it is going to be a case of we can have better conversations both with the taxpayers as well as with the policymakers around the direction that we can take as a society. And that, in my view, is an integral value over and above that. From this data that we are able to collect, then the Revenue Authority is also able to make informed decisions in terms of who to actually target when it comes to things like audits. We are talking about getting certain individuals or certain businesses that they were not in the net, now in the tax net. You remember not so long ago, we had the value-added tax auto assessments. And these were only being driven by the fact that the revenue was able, using your tax identification number, to basically relate to the fact that I have this transaction, which is a sale transaction from one business, and is a purchase transaction either by an individual or by another business, and one leg of the transaction is actually missing. You wouldn't be able to get that kind of intel if you were not then adopting e-invoicing, for instance. But at the end of the day, I think it does also come with its own challenges. If you think about a country like Kenya, we do pride ourselves with things like the internet penetration. But at the end of the day, I don't know whether one could actually say that this is available across the country, whether it's because of just the access of the internet, or whether it's outages because of factors like just a supply of electricity and the likes. So in essence, if you then go the route of insisting on everyone being on e-invoicing, have you done that homework to ensure that in actual fact everyone is able to generate those e-invoices? Otherwise you then end up marginalizing certain businesses who are not then able to comply with this e-invoicing requirement, and also forcing business to either, like I said, marginalize those small and medium enterprises who are not necessarily able to generate e-invoices.
Thank you very much, Job, for your time during the Global Tax Talk interview. We look forward to hosting you in the near future. And to our viewers, thank you for joining us for this Global Tax Talk series, and we hope that you'll join us next time for you to remain global tax ready.